Hello and good morning, evening or afternoon, depending on when you are streaming our latest panel Susty Talk from Edie. For those unaware, Susty Talk is our series of video interviews designed to keep us feeling a bit more connected while we are probably working remotely still for the majority of us. And we have one-on-ones, but today I'm delighted to have a panel, all experts on green finance in their own ways, to touch on this crucial topic as part of our countdown to COP26 festival. So over the next 30 minutes or so, I'll be chairing this discussion with, and I'm just going to go clockwise as I can see them on my screen. So I've got Duncan Grierson, who's the CEO and co-founder of Climate Invest. I've got Iskander Vernoit. I hope I'm pronouncing your surname correctly. I've only seen it written down. Policy advisor for E3G, focusing on sustainable finance. And then I have Piva Tiboom, the Secretary General of the FIA EPTA. So thank you all for joining me this afternoon. How is everyone? Are we all well?
Super well, thanks.
Yes. Quite well, thanks.
Great, and we're meeting as part of our countdown to COP26 festival, so I think it would be obvious just to introduce everyone really, and to start with as well as part of your role and what you're doing, what your big focus is in this area in the run up to COP26. I'm going to pick on Duncan because he was talking about some pretty interesting developments off of the recording.
Great, thanks, Sarah. Yeah, so maybe just a quick intro on what we're doing. So we at Climate, we've launched an app in the app stores that allows anybody to invest in the companies that are having a positive impact on climate change. So we like to say that we go beyond ESG. Obviously, there's a lot of talk about ESG, and our focus is really on finding those companies which are actually having a positive impact rather than screening out. A bit more background, we've raised about $10 million in seed funding with 30 people now. We're growing our user base week on week, and we're actually raising a bit further capital right now on Crowdcube and crowdfunding. We think that's a great way to get our message out, is to have our users also as shareholders in the business and join us on our journey. So would welcome any of your viewers, listeners, readers on board as shareholders as well.
Great, and Duncan, we can come back onto exactly what it means to invest sustainably beyond ESG in just one moment. But for now, for the next introduction, could I maybe come to Iskander?
Yeah, absolutely. So at E3G, we're a climate focused think tank, and so we mostly work on matters of public policy at both the national and international level, so looking at climate politics. And I think on the sustainable finance front in the run-up to COP26, I suppose I can break down, if you will, what we're looking for into three main parts at the global level. The first is, first of all, in the context of COVID, we need to ensure that government recovery responses are green, and that green and the recovery spending is green in order to realize the green recovery that we've heard a lot of rhetoric about from policymakers. The second is essentially for seeing the requisite international economic and financial cooperation to ensure that green recoveries can be realized around the world, including in countries that are currently suffering from debt distress in the developing world. And then last but not least, and this is perhaps of most relevance to this conversation, is we hope to see the sort of beginnings of a broad suite of sustainable finance reform for the long term, but that has to begin this year. So effectively, it's a three-part answer to your question, but it's as far as policymakers and politicians meeting at international summits are concerned, it's one big agenda.
And I'm sure we can break that down a little bit throughout the next 30 minutes as well. So for introductions, it's just Piva remaining. And yes, what is FIA EPTA up to this year in the next 5 months or so?
Yeah, thanks, Sarah, and delighted to be here. So EPTA, the European Principal Traders Association, is the European representation of the non-bank market making community. So we have 30 members across Europe, which are all non-bank market makers who are providing liquidity to end investors on exchange traded markets across Europe. So what we do is to make sure that investors at all times find prices on the exchange we link up basically supply and demand in exchange traded markets, and that helps to ensure that trading costs are lower for the end investor. And increasingly, we are also providing that liquidity in ESG products. We see a big shift, both by investors, but also critically by exchanges, in listing new ESG-based products. And we find it critical that that product ecosystem develops more, and our members are really committed to helping that that work. But that is something that we need to do across the financial sector and the industry. So starting from the end investors, the banks, the exchanges, and also the whole infrastructure that sits behind it, the so-called post-trade infrastructure. And we sit really in the middle part of that, making sure that buyers and sellers are linked up and doing that in the most efficient way.
Perhaps I could start there then, because it does seem, as someone who's in my job, that every day I get a new email about new ESG products and new this, that and the other. But ultimately, when you take a step back and look at the actual proportions, and that's before you even get into, are they properly ESG? Do they actually go beyond that? It's still a really small proportion of the whole. I don't have a specific figure to hand, but any study into this has shown that. So Piba, I wanted to know why this is still a separate category and not yet the mainstream. So what's been holding back the growth of this sustainable products I know that you operate in the EU and the UK. Right. So in both of those jurisdictions, really.
Yeah. Well, so certainly one of our big focus points in our work around ESG is to make sure that there's really a mainstreaming of ESG products in the environment that we operate in, which is exchange traded markets, because we really see that to make sure that ESG products can help to actually support the green transition, they need to become part and parcel of how the markets operate. And that is actually why also with our members, we developed a set of principles of how we go about dealing with this space. And an important aspect to that is to engage with other relevant stakeholders in our space, so the exchanges and the end investors, to make sure that product specifications, for example, are as much as possible standardized, that basically you know exactly what goes into these products. And we've seen also quite a bit of fragmentation, kind of Me Too efforts to just also be part of this development. And on the one hand, that's good, but if there is too much fragmentation in terms of the products, then you also basically build in a level or a degree of inefficiency. So it needs to be balanced by, becoming more widely available, but at the same time still sufficiently reasonable so that it doesn't become too much, if that makes sense.
That makes sense, and I can see everyone else on the call nodding. I could maybe come to Duncan here on this idea of taxonomy and shared principles, which is really evolving quite quickly in this space. And you mentioned that Climate tries to go beyond that, to go beyond any ESG condition, and on the site it says a truly sustainable investment. And I know this is something you probably have to bake in and think about right from developing Climate. So I'd love to hear about how you classify that and aim to deal with some of this lack of standardization or some of this greenwashing in the conversation.
Yeah, no, absolutely. No, I think this really goes to the core of what we're trying to do, and I think what we're doing is in some sense very, very simple. In another sense, there's some complication or complexity with it, and so that sort of our primary way for selecting the companies we invest into or help our users invest into is really, really simple. Does this company have a product or service that's having a positive impact on climate change? And I think that's quite different from sort of ESG filtering, which is typically sort of negative filtering, so screening out things. And we're sort of, if you like, at the far end of the spectrum. We're filtering things in. We're positively looking top down, bottom up for companies that are having a positive impact on climate change. That's kind of our primary filter, and it's probably useful to give a couple of examples. So we have some themes we're focused on, and sort of the core ones are clean energy, clean technology, and smart mobility, which is mainly electric mobility. And a couple of examples of companies would be Vestas, which is a sort of leading global manufacturer of wind turbines. And so obviously that product is having a positive impact on climate change because that helps facilitate the creation of renewable energy. Another example might be Schneider Electric, which is a French company, which is a leader in software and hardware in the energy efficiency and the energy transition market. So they manufacture switching gear, they manufacture electric vehicle charge points, and a whole range of software for the energy transition. And so some of these companies in our portfolios is kind of household names, others less so. But every one of those companies has a product or service that makes a positive impact on climate change. So that's kind of the primary filter. And then we will use tools which I guess you could say are similar to ESG principles, which is we then look at social and governance. You know, are these companies well run? Do they have diversity? Are they, you know, what are the direct impacts of those companies themselves, rather than just necessarily kind of feel like scope 3, 4 emissions of their products? And so, but our primary filter is, if you like, a little different from kind of ESG, and that's, you know, that's really our mission, is to try and have an impact on climate change, rather than necessarily rely on sort of third-party tools like ESG. So I guess we're a little bit out of the norm, but we're finding a user base that wants that. We're finding a user base of people that are a bit frustrated, I think, with ESG tools, especially when you see that all of the providers, or many of the providers of different filtering tools, will often be at conflict with one another. You know, so they will look at one company and one company will say this is fantastic on one ESG measure, and then another rating agency will say exactly the opposite. And so I think, you know, there are challenges with ESG, and so our positioning is that we use that as a if you like, a secondary and tertiary tool, but our primary tool is quite a different one.
In your mentioning of, for example, that some of these tools are actually clashing with each other, I wanted to come on to the role of policy in unifying that, which we are seeing some moves towards. So we've heard a lot of updates about the EU's green finance taxonomy. We had announced here in the UK that work has now started to build our own one of these. So, for example, all ESG ratings might be compelled never to call, for example, an airport expansion environmental by any metric, or a road expansion. So I wanted to come on to what the panel thinks about this, and I can see Iskander nodding a lot, and I'm aware I haven't brought him in yet, so could I start with you?
Yeah, very happy to jump in. I mean, as E3G, we've been quite actively engaged in the conversation around the EU taxonomy, and in the context of the planned UK taxonomy. One of my colleagues is actually sitting on the technical advisory group there. I mean, I think the EU taxonomy represents a big step forward in terms of providing clarity to investors and to capital markets about what's sustainable and what isn't. And I think the mark of its success is the fact that it's been broadly sort of replicated as a policy measure by a number of market jurisdictions, including the UK, which we know is planning to use the EU taxonomy substantially as a basis for its own taxonomy. And I think that certainly that kind of overlap is appreciated by investors who don't want to see policy bifurcation and different standards in different markets. So I think there are outstanding questions about the UK's taxonomy and the degree to which it will diverge from the EU's. Obviously, there are geographic specificities to take into consideration, and the specificities around planned decarbonisation pathways. But this is ultimately something that's true of any of the different countries that we look at that are producing taxonomies today. Obviously, there are sort of political considerations and important distinctions where people seek to, in some cases, distinguish between different types of infrastructure, say, as being sustainable in the context of the developing world in terms of the imperatives that are faced there, but not in the developed world. I think those kinds of conversations obviously entail a lot of questions from the standpoint of environmental integrity, which have to be addressed. I think ultimately what we don't want, and what we've seen a lot of conversation about in the press, is a risk of greenwashing that's state sanctioned in these sorts of cases. So this is why I think it's important and useful to have taxonomies that are rooted in the science. I'll stop there.
Great, I'm sure we could carry on all day, but I did want to come on to this other big elephant in the room, really. So we've talked there about a lot about definitions and regulations and categorizations and taxonomies, but obviously the big question is actually how do we scale green finance to the levels that are needed. And Iskander, I'd like to stay with you here, because one of the big headlines we've had recently is that it was recently G7, the nations all met, and they essentially said, look, we know we're off track to our 100 billion per year figure for international climate finance, all to be going towards developing and emerging economies. And that was sort of welcome, but I'd say with only lukewarm reaction. It was sort of like, it's nice that you're rethinking about it ahead of COP26, but you're off track already. Why wasn't it brought up sooner? So I wanted to ask about your take on that, and also how we can make sure that even if we do get to that 100 billion figure, how we can make sure that it's going to the right places. We've seen so much about how adaptation, and particularly maybe water infrastructure in that, is very underfunded.
Yeah, hugely so. I mean, I think there was quite a bit of coverage about the G7 outcome from Carbis Bay. I think by everyone's admission, more has to be done. I think the question is, why it was perhaps that the G7 didn't do more in light of what we've known since last year, at least. Is a substantial shortfall in terms of what's required to deliver the 100 billion, which in fact was pledged over a decade ago originally in the Copenhagen COP15. And so, expectations from developing countries are very high for COP26, and it's important, for their trust in the international climate regime, that developed countries can live up to their pledge on the 100 billion and actually make amends for not having met the promise to have made it in 2020. And so, there have already been commentators like Lord Nicholas Stern, the eminent climate economist, who've called for developed countries to commit to new targets of 150 billion by 2025. What that would require is a step change in investment in the international financial architecture, notably the multilateral development banks, which have important roles to play as stewards of private capital as well. And so I think in that sense, the G7 didn't really step up as many people were expecting. There was a lot of conversation about a new Marshall Plan, a green Marshall Plan for developing countries, but thus far there hasn't really been any discussion of concrete numbers to be put behind it. And I think it's not just developing countries now that are looking for numbers. It's also investors increasingly. And the capital markets recognize that in order to invest in emerging markets at scale, there needs to be strong underpinnings in terms of public finance as well as public policy for de-risking and other measures to ensure that we can achieve the scope and scale of investments that's required over the course of this decade if we are to halve emissions by 2030, as the IPCC has instructed us is necessary, but also, as you raised, the very important scale of the adaptation and resilience finance gap remains, and obviously the role of public investment there is absolutely critical, and investors are realizing this, and this is why we're increasingly seeing the private finance community calling on governments to be stepping up.
It does seem like a different two-way conversation at the moment here in the UK. So we've got more and more calls to action from the private sector, and then at the same time the government seems very keen to emphasise that private sector piece. There's a lot of focus on businesses in the run-up to COP26, and whenever there's a commitment, it's matched with private sector. So the National Investment Bank just launched, and they actually set a target, you know, as well as what we're giving, this needs to leverage a further 40 billion from the private sector. So I wanted to bring our other panelists just in here in terms of which specific things in that sector need more support, private and or public. So Piba, we talked at the beginning about this liquidity and about certain product, but I wanted to come on to specifically, are there any specific asset classes here in the UK or in the EU which are better or worse developed in terms of ESG, in terms of being sustainable, and perhaps why that is?
Mm-hmm. Yeah, so just to manage expectations, the bit that we have sight of just by the nature of who our firms are is really the part that sits in the capital markets, so the exchange traded part. And of course, when we discuss the huge investments that need to be made into the green transition, the capital markets section of that is just a part. There's also the direct investment, there's the government investment that needs to be made. So just by our very nature, we can speak to this subsection, but I think there one critical aspect I think that the secondary markets, so the exchange-based markets, can facilitate is, in addition to direct investment and return on investment, is also risk management, because especially in the exchange-traded derivatives markets, so products like futures and options, those are typically the kinds of insurance products that corporations can use to hedge business risks. And increasingly, the ESG risks are becoming of the same type of nature. If you see a strong call from public authorities to look at climate risk as part of other types of risks that need adequate risk management, so traditionally like financial risk management or liquidity risk management or exchange rate risk management, these types of things, climate risk is part of that now too. And the risk management products that traditionally exist, so these exchange traded derivatives, can play a big role there, we believe, in helping companies to manage those risks. And what we see there is that is under development. So I'm not saying that it is that it is not sufficiently developed for what the current need in the market is, but we certainly see it grow. But I think policymakers are asking for companies to focus on this risk management. But I think linking that up with mechanisms that exist and have traditionally existed in the market, that is perhaps something that still needs more education. And that's also something where we, with our sustainable finance principles, want to play a role in.
Fantastic, and I'm sure that's something we'll see a bit more of going forward as well. And Duncan, I wanted to come to yourself with a similar question. So now looking forward to the net zero strategy, there's a lot of questions about which projects and technologies should we be investing in and when. So not just, for example, like a risk product or a mortgage or a reinsurance, but specifically what infrastructure and what technologies. So I wanted to ask whether Climate is looking at technologies that are already mature or projects that are shovel ready, or whether there's a sort of future looking here.
Yeah, no. So to date, we've been offering portfolios in companies that are listed that are mature. I would say mature companies with typically sort of multi-billion-dollar market caps. If you like, these are sort of shovel ready. These are already existing technologies. They're typically putting money into or developing. So solar, there's quite a lot of solar and wind, within the clean energy element of our portfolio, and then clean tech and electromobility, and we need more of that. These are the kinds of technologies that are mature, low risk, and the world needs to be pouring trillions of dollars, pounds, every currency into those kinds of technologies now. But we also need, which I think what you're talking about, some of those moonshot technologies. So things like carbon capture and hydrogen. It's less mature technologies. They also need funding because we need all of it. It's such a massive problem we're facing with climate change that we need to be funding stuff right at the end of the pipe, if you like, that is already out there and scaling and scaled at massive scale. We need to be putting lots more money into that stuff, but we should also be funding earlier stage businesses, and that is the kind of thing that we're also looking at doing, and actually is what I've been personally involved in for the last 20 years. In building and investing the companies sort of in the clean tech space where there is some element of risk, but you've got to fund them earlier to get some winners, right? So that kind of funding needs to come from a mixture of private but also government, and I think we are beginning to see more government funding for things that have got some risk attached to it. There definitely is a lot more interest in clean tech in the last 12 months. I think one of the upsides of COVID has been that people are thinking much more about systemic change. We need to change the way we all live, behavioral changes, how we move around and how we eat, and how we live in our homes, more green energy being consumed. So I'm very optimistic that we will see lots more money going into the mature stuff, and I think the earlier stage stuff also needs a bit of a push, but I think that there's goodwill there now. I'm seeing pretty much every week in the private markets, there's a new venture fund being launched and has raised money for another 100 million euros, another $100 million, in Europe, in the UK, and in the US. There's lots more focus on this, and it's literally exploded in the last 12 months. So I'm hopeful that there's a whole range of different funding mechanisms that is coming through and will have an impact both earlier and sort of for the later stage companies.
Well, Duncan, seeing as that's such a positive note, I think I'd be remiss not to stop there and risk going back away from that tone. So I'm going to bring the panel to a close, and thank you so much for your time this afternoon. We're actually recording this ahead of edie's Sustainable Investment 2021 conference, which is entirely virtual for the second year now in a row, and this is taking place on July 13th and 14th, bringing together asset managers and owners, corporates, regulators, policymakers, stock exchanges, NGOs and industry bodies, rating agencies, and pretty much everyone else across the financial space. So to have a look at our full agenda and to register to come along virtually, the site is event.edie.net/investor. That's event.edie.net/investor. So if you've enjoyed tuning in today, which I hope you have, I'd really encourage you to check that out. But for now, it's a goodbye from myself, and all that remains is to say goodbye to and thank our panel today. Thank you so much.